Hi, this is Corey. It's top of the hour. We're just going to give it a minute as I'm watching people log on. So we'll get going in just a minute. All right. We'll kick this off. Again, I appreciate everyone that's taking time out of their busy day to listen. This is part two of a three-part series that we're doing regarding success planning, preparing, and profiting from your business exit. Today's session is on the preparing, and I'm excited to have this team assembled to kind of go through and talk about the today's subject, which is management leadership readiness. And this, just want to mention to everyone, this is an interactive webinar, so please ask questions, and if we don't address it right away, we'll probably get to it at a later point. But again, we like this to be an interactive webinar. I'm excited about the team that we have pulled together today. I'm the moderator. My name is Corey Parnell. I'm a principal at BGM, and I'd like to introduce Diana Ross Hanson, who has over 30 years of industry experience. She is very dedicated to assisting business owners in achieving their exit succession planning objectives. She does a great job in regards of making a well-informed, strategic, and tax-efficient decisions for her clients. She's very collaborative with the owners and their advisory team, who help plan their debenture. And a lot of times, if the perfect world, she's been working with them 3 to 10 years to facilitate this. The next individual I'm excited as well is Pat Schreiber. He has over 25 years as a corporate and transactional attorney, focusing on small to medium-sized privately held companies. One super notable for Pat, he's been a super lawyer since 2009, probably when he graduated from law school. Pat practice includes advising clients on choice of entity, general corporate and partnership matters, shareholder and partnership relationships, business combination matters, including mergers, acquisitions, stock deals. And the last person I'd like to introduce is my other partner, Blake Johnson, who has over 15 years of working with closely held sellers, buyers, and advisors throughout the information gathering, marketing, and transition process. He conducts research and pertaining to the clients creating go-to-market materials, overseeing timeliness, assisting with market development, and managing the client communications during that whole transaction period. So again, appreciate all of you individuals taking out time from your busy day, and we'll jump into it at this time. So the first subject matter that we're looking at, kind of talking about, I'm going to start with you, Diane, is how to prepare your internal team for succession and identifying any gaps. So if you want to jump into that'd be great.
Yes.
Yeah.
Thank you. Thank you for that introduction, Corey, and it's a pleasure to be with you today, as well as continue this series, as you had mentioned, number 2 of 3. When we talk about the whole succession and transition, you'll hear all of us say better preparation equals better outcomes when it comes to ownership, transition planning. And certainly, management leadership readiness is a in my opinion, a pretty significant piece to this. In fact, I had attended a Midwest Business Brokers and Intermediary session last week, and they talked about the three greatest deal drivers and three greatest deal killers. And the two greatest deal makers kind of came, quite honestly, very close. The operational performance and certainly financials is right up there on top, but following by just a few percentages is the idea of leadership team and continuity. And in fact, they identified strong leadership team that's worked together for some time and who are interested in staying in place after a transition is probably the top deal driver. So, as far as management leadership readiness, succession readiness isn't really a one-time event. It's about developing leadership bench through cross training, through mentoring, through exposure to real life decision making. Certainly owners can take a look at assessments to help identify skill gaps, or certainly documenting processes. All of those help to develop that leadership readiness. A lot of times I'm asked the question of, well, how soon should an owner consult their key people in the decision making process of transition? And that's a great question, and it's commonly asked. And my comment to that is, first of all, I'd ask an owner, could any of those key people be a potential buyer? Because employees, believe it or not, key people appreciate being considered. In one deal that I worked with, we helped key employee explore SBA financing. They didn't qualify, but instead of feeling overlooked, they became a real valuable advocate during the sales process, assisting in the buyer meetings, supporting due diligence. In another case, a seller ignored a key person who they believed really didn't even have the chance to buy. After the sale, that employee recruited 4 co-workers and launched a competing company. So lesson learned is, don't underestimate the key employees and their potential impact. They, by communicating the transitions early, owners better able to manage the information flow, accuracy, and quite frankly, they depend upon their leadership to help in this. Retention plans, I'll mention just very briefly. Retention plans for key managers aren't just a nice to have, they're really essential for preserving value during a transition. Buyers want to know that the talent is going to stay and that the business is going to run smoothly after the owner steps away, whether it's stay bonuses, phantom stock, profit sharing, long-term incentive plans. Absolutely, those type of plans, incentive and retention, are going to align your key people's success with the company's success well before and after any sort of transition. So yeah, preparing them, assessing their readiness, incentivizing them, retaining them is critical as they get ready for transition, in my opinion.
Blake, if I remember recently, you had a transaction where I can't remember if it was key employer and key employees that really changed the momentum of the deal.
Yeah, yep. I would definitely concur with Diane's assessment. That incentive piece and aligning early on, the earlier the better, and controlling the narrative and the accuracy of what's being communicated is extremely important. Yeah, our transaction earlier this year, actually, we were a couple of weeks away from completing the deal, from the closing date, and one of the key employees was terminated. And definitely sent ripples through both the buyer's diligence team and the buyer acquisition group, as well as sent our client, the seller in this case, scrambling to make sure that they were positioned well, not only for the transaction but just to continue operations as an entity. And ultimately, those hurdles in some fashion arise, and that preparedness piece helps mitigate that risk.
Yeah. Dan, can you share some of the most common gaps that you see in the business beginning when they're preparing their leadership team for succession or even development of a leadership team?
Yeah, the development and assessing is not actually an area of specialty. There are individuals that offer those assessments and also do the coaching. If I were to respond, Corey, to that question, I think probably the biggest gap, if any, that I have seen is just lack of leadership skill. Particularly it might be, well, I was going to say family business. That's not actually true. Um, Gaps primarily in leadership skills. That's been my experience. And again, those can be mentored. They can be developed. I think the key is to do it well in advance of when the owner is thinking about taking the company to market, whether that's internal or external.
Yeah, you make me think of it's the unplanned succession. The four Ds. I'm forgetting the fourth one, but it's like
Death,
death,
disability, divorce, and disagreement.
disagreement. That's the one I was missing. Yeah, I'm sure, Pat, you've seen that before.
Sure. Lots of disagreements.
Yeah. So that kind of the next subject here is the valuation and financial readiness. Why knowing your company's value matters and when to seek a formal valuation. Like I'm sure you run across this question all the time.
Yeah, and it's a great question. And there's a couple of different ways to look at valuation of a business. And we'll speak today primarily about a market valuation as opposed to an estate planning or gifting type formalized valuation. That's more of a formulaic approach for the IRS. This is in this webinar and this series, we're talking about primarily a third-party transaction or an internal sale at a market or close to market valuation. And really, to answer the initial question, which is, why knowing your company's value matters, is because as a business owner, you want to be informed on what that calculation looks like and where you can create over time, additional value for yourself and the stakeholders. So, starting really with that financial preparedness, what we see and recommend is, really digging into organizing, cleaning, and reviewing the financial records of the business. Sometimes that's a combination of an internal accounting team alongside an outside CPA, depending on the size of the business, the industry, the needs, inventory requirements. You could consider a year-end reviewed statement with your outside CPA or an audit. And all of this, and kind of in a similar vein to the management readiness and the other topics, it's about managing risks and preparing to defend and present the company in the best light as possible. So we've always worked with potential sellers and business owners to understand what their individual accounting gaps might be. And more recently, a trend has been to use kind of a preemptive, a sell side look at what's called a quality of earnings report. And really what that does, it's a primary financial diligence tool when a buyer is going to look at a business. And what that does by preempting that process is give sellers the tools to understand what a buyer might see when they dive deeply into the proof of cash pieces of the business, the accounts receivable, and a number of other areas that ultimately help the buyer in a transaction timeline get comfortable with financing and moving forward to a close. So it can't be overstated. The clean financial records in whatever is appropriate for the individual business is extremely important. We've seen everything from handwritten statements that we need to bring in somebody to help establish the correct financial reporting tools and process to past CPA who's now a business owner that's got the cleanest books and most on the pulse touch to his business and everything in between. So that's really a foundation of creating the value and very important. A couple of pieces where we see business owners tend to miss in the financial preparedness aspects, again, primarily speaking about smaller businesses or medium size or transitioning businesses, is, the budgeting and forecasting process. The historical financials may be clean, but the team really hasn't taken that extra step to look forward and to track budget versus actual over a given period of time, and really defend what is going to be presented as the future of the company. Additionally, we see businesses that have adopted some form of managerial reporting or key performance indicators alongside their financial statements as extremely valuable in understanding the drivers for that specific company. And all of those tools ultimately feed towards defensive cash flow, which creates value, but several other pitfalls in just, again, financial preparedness and preparing statements, deviations from the generally accepted accounting principles, GAAP. Those are all these areas to scrutinize with your accounting team, both internal and external. Understanding the difference between cash versus accrual accounting. There's a lot of benefit in cash accounting, specifically when it comes to tax return preparedness and tax mitigation or deferment. But when we're looking at the actual operations of the business and the cash flow, accrual-based accounting is significantly more beneficial. Revenue recognition is another area that, depending on the business, may need additional scrutiny to make sure that things are uniform month to month, year to year, and showing truly a snapshot of the business in any interim statement. We've also run into problems with sales nexus and working capital management, missing accruals like bonus and vacation accruals. Those are all just pieces that your outside transaction CPA could help assist in preparing your business. I'll let the team chime in on anything financial preparedness area before I kind of move on to kind of valuation thought process.
I have a quick question for you, Blake. I had a client that provided a value and also financial statements, and then also included a list of work in process for the next year. Is that something that weighs very heavily in determining a company's value, that work in process? I don't know.
I think to the extent that a business has insight into a backlog or a pipeline or a run rate of the present cash flows or maybe growth, will always help add certainty when you're doing a transaction. If you are in an industry where you're signing contracts for projects that extend out 2 quarters or a whole year, and you've got a book of business that will come with the sale day one, yes, that definitely helps inflate how buyers will consider the risk of the transaction.
Okay, thanks.
Yeah, the one thing I'll mention is I think it's 7 out of 10 or 8 out of 10 financial statements that there's missing components to it, whether it's I'll call it a modified accounting versus GAAP accounting. And then it definitely impacts the valuation in many ways. Working capital calculation can be way off because of that. So again, not to be the CPA, but good books and records definitely come into play much more than when you're providing that information to your CPA to prepare a tax return. They're just taking that information and preparing it, trying to minimize taxes.
If I can just chime in from a legal perspective on that, because I see the other side of it when I'm helping to negotiate and finalize deals. And I often see cases where sellers are surprised that their financial statements are scrutinized to the extent that they are, and that they're being normalized. You mentioned that some, in fact, maybe a majority of companies out there don't keep GAAP compliant books. And part of the process during the sale is to effectively have the buyer normalize those to make sure that they're either GAAP compliant or compliant with whatever accounting standards that the parties agree to. And that can result in big swings in value, because if the seller is doing an accounting treatment for something that is non-GAAP, and we normalize for GAAP compliance, it can really have an effect on things and can change the purchase price, which is the bottom line important item for sellers. So I completely agree that making sure that you're aligned with your accounting professionals, making sure that your books are accurate and at least somewhat GAAP compliant. I can't vouch for 100% GAAP compliance will help you head off problems down the road.
Yeah, and I think just to continue in this line of questioning towards the valuation piece, it's ultimately the foundation to create the enterprise value. And you know, when it comes to those negotiation points, as Pat stated, it gives you as the seller, as the business owner, the strength to negotiate from a position of accuracy and power, as opposed to getting into the process, finding errors, and then suddenly having to react to those errors or normalizations from the buyer's lens. And you know, when sealed bid, when we're working with sellers and we look at valuation, you know, there's a number of different valuation approaches. You know, we use a combination of a market approach and an income approach. So really just using comparable companies and their peers to analyze, you know, market cash flows. Most commonly, we'll use an EBITDA multiple or earnings before interest, taxes, and depreciation and amortization multiple, or a seller's discretionary earnings multiple, which is used in smaller businesses, as well as, when possible, a discounted cash flow analysis, which relies on, you know, accurate and confident future cash flow projections. But you know, what we're seeing in the market right now, which also impacts valuation, is you know, a lot of dry powder, a lot of buyers chasing quality companies. And despite, you know, interest rate changes and some of the squeezes on capital on the debt side of the market, there is still a large appetite for quality companies. And when we do valuation preparing in this, you know, process, we'll use a range and a number of different resources to identify what's common in the marketplace. But ultimately, as I previously stated, you're not going to know the true value of your company until you go to market and until you start that process. But you can understand the drivers and areas that you can add value. As you know, I think one of the questions that we've talked through is when do you start this process? And the answer is, you know, years in advance if possible, so that you can clean up those items on your financial statements and drive value that ultimately impact the enterprise value of your company.
This kind of leads us into the next areas, legal and operational housekeeping. Pat, I'd love to hear your thoughts in regards of, you know, ensuring key contracts, agreements, records are in order to make sure the transaction moves forward smoothly.
Well, somebody mentioned earlier that it's not uncommon for selling companies to be less than precise in the preparation and maintenance of their financial records. I'll put that politely. And all that means is that different companies have different systems for maintaining their financials. Obviously, software has made it easier to maintain those records now, and we see a lot of people on QuickBooks and other similar systems, and that's very helpful. There's no counterpart system for maintaining documents, but whenever you're involved in any kind of sophisticated business sale, and when I say sophisticated, I mean one step above using a retail business broker, it's likely that the buyer is going to put the seller through its paces and determine what records it has, what agreements it has, whether everything is in order. And there's a whole diligence process that happens as part of that. I guess my advice to people would be to exhibit and to practice good corporate hygiene. And what I mean by that is when you get agreements signed, make sure you keep the signed agreement. And I can't emphasize this enough. The unsigned agreement will be disregarded by most parties as nothing more than a description of what might have been agreed to, but we want the signed versions of everything. But keep the signed documents, keep them ordered so you know who your agreements are with. And if you can, and I know that this isn't always possible, have consistency across the documents. most likely the seller's counsel and the buyer's counsel are going to go through all of those agreements, and they're going to be looking for certain things. And if there's consistency across those documents, for example, if you've got 50 customers and they all have a very similar agreement, it's going to make that process easier and frankly cheaper. But it's important that you have that. There's a lot of time spent during the due diligence period and the pre-sale process, just going through those documents, tracking them down, making sure that everybody has access to them. And it takes people by surprise. So that's really important. As far as the key organizational documents, I think the articles and bylaws, while they're good to have and everybody will ask for them, are probably not as important. The thing that I think is really critical is especially when we're in an environment where there's a lot of S corp deals, is making sure that all of your tax filings, and I don't mean your annual tax filings, but your S corp election or your Q sub elections or your QSST elections or something like that, are in your file and you've got notification of receipt. I'll just share an example from my own history where a client who was operating in Iowa, they had operated for years using a parent and Q sub relationship, had done all of their tax filings over those years in line with those elections. And when it came time for a buyer to come in, they asked for copies of the Q sub filings and they couldn't find them. We eventually had to send the president, put him on a plane, go to the IRS regional office, and they literally had to sit in the office and wait until somebody would pay attention to them so that they could confirm that those Q sub elections had been received by the IRS. It turns out that they had, but we couldn't independently prove that they had been. I'm not trying to point fingers. It was the prior accounting firm that had sent them in and not had a receipt of those back. But that one little issue probably, it didn't delay anything. So it didn't terminate the sale or anything like that, but it cost days of time and a lot of personal effort from the CEO in order to get it taken care of. It's a lot easier to take care of those records on the front end and again, exhibit that good corporate hygiene in order to set yourself up for success.
Yeah, so is there, and I know, for example, like we've been over the last 3 years kind of developing annual to-do or checklist, like the profit sharing approval, the renewal or of the new CEO in our case, and so forth. Just developing a good standard list to look at and make sure that these corporate records are being done and maintained. As well as I know a client that was going through a significant transaction and came to find out, I think about a third of their agreements were not executed by the customer. So a lot of time and energy trying to get that resolved before the buyer would even move forward.
Yeah, and again, this gets back to that corporate hygiene. I think it's certainly, the CEO is ultimately responsible, but it usually falls to the CFO or the COO to put procedures in place to make sure that things are done. And you mentioned a couple of things there. One is to at least annually confirm that whatever organizational records are maintained, and that could be annual meetings of the shareholders, of the board of directors, updating any incentive or deferred comp plans or anything like that. It could include, in some companies, getting an annual valuation for purposes of determining what that deferred comp baseline will be or something like that. But then also with regard to contracts, and especially customer and vendor contracts, I think it's incumbent upon companies to train the people that are on the front lines to make sure that they, to your point, actually get a signed agreement. We all know salespeople are interested in making sales, and there's nothing wrong with that. Everybody wants a lot of sales, but they are less interested in making sure they get a signed agreement. So if, for example, the CFO conditions a payment of commission upon receipt of a signed agreement that they can put in their file and make sure that they've got the signed one, it's going to save a lot of pain later on. But somebody has to take ownership of that issue. It's not a very sexy role in a company, but it's an important one, especially when you're positioning a company for sale.
Yeah, I don't know, Blake, if you have any experience running across regarding the readiness.
Yeah, I've got a couple points for Pat to speak to. One, on customer and vendor contracts, What have you seen for the ability to get assignability into the agreements in advance, and what would you recommend for business owners related to that?
Yeah, no, that's a good point. In every, well, I shouldn't say in every deal because equity deals are different, but in every asset transaction, and a lot of deals over time are done on an asset basis rather than an equity basis. The assignability of those contracts becomes critically important. And there's no single standard for whether an agreement is assignable or not. But what we look for as lawyers and what the buyer's counsel is inevitably going to look for is whether those agreements are freely assignable or whether you need the consent of the third party. So let me use a common example. If I'm leasing warehouse space from a landlord, well, maybe a lease isn't the best example because it's rare that a real property lease won't include an assignability clause. But that means that in order to sell my company and assign that lease to the buyer, I'm going to need to go to the landlord and get their consent to that assignment. It's usually a matter of routine, but it requires time and effort. And if I can avoid that in all cases, that would be great. So if I'm putting together a customer agreement, I want to avoid permitting my customer to consent or not to assignment of the agreement, so that if I'm selling my company and I'm making widgets and I have contracts with all of my customers, I want to be able to freely assign without my customers' consent all of those contracts. It just reduces friction in the sale process. Most attorneys should know that. I'm not sure that non-attorneys really pick up on that issue. And I can guarantee that's one of the pain points whenever we do a deal is the assignment of these third-party contracts, just because it involves somebody who's not necessarily involved in the deal. They're not getting anything out of it. You're just asking them for something. I inevitably and almost uniformly hear from my clients that it won't be any problem. We'll get those consents. I talk to Joe all the time. He's a great guy. And I tell my clients weeks ahead of time, get that consent in front of them, talk to them right now. And what they tell me back is, well, I don't want to say anything yet because it's a small business or a small town, and I don't want word to get out to my employees. So the client ends up waiting until 3 days before closing. They go to Joe. It turns out Joe's on a fishing trip in Canada, and the person that he talks to can't make a decision without Joe, and it ends up gumming up the works. Your lawyer should be on top of that if you're using an attorney to go through the sales process, but it's just an example of one of those little hiccups that most people wouldn't pick up on as an impediment to the sales process.
It's definitely fun trying to get a signature from somebody on a fishing boat. Unfortunately, I've been there. Yeah.
DocuSign has made it easier to get those kind of signatures, but it just tracking people down. And then also it's possible that your lender, especially, or either lenders or landlords, might require some kind of compensation for this assignment. And a lot of commercial landlords write it into their agreement that they get compensated maybe $1,000 or $2,000 to give that consent. So just realize that that's out there and it's something that needs to be taken care of.
Yep, I think you totally covered it. I think the only other war story I'd add to that is, it's the flip side. They haven't been talking to the people and can't track them down or can't get the right number, and suddenly, this relationship that's just worked for maybe sometimes years is it's just even a process to find the correct person to get the agreement reviewed, approved, and executed. Maybe one other point, Pat, for you to cover on the legal side of things is buy-sell agreements. We've seen several transactions with minority owners where there's maybe not a buy-sell in place and they're working on statute, or there isn't 100% alignment on a transaction or to sell in general. Maybe speak to how you manage that process.
Well, that's really important, especially given the fundamental distinction between corporations and LLCs. Obviously, the LLC is the most attractive business entity now, regardless of how it's taxed. Corporations are a little bit easier because you don't necessarily need the consent of the other shareholders in the company to sell equity, and you only need a majority consent to approve a sale of the assets of the company. That's not necessarily the same with the LLC. And it's important, I think, on the front end to have an agreement that permits the sale of the company's assets with a simple majority vote or maybe even a supermajority vote, but try to avoid the unanimous requirement that the statute requires. And also, which maybe permits the majority interest of the equity holders to sell their equity and drag along the minority owners in the event that the majority want to sell equity. A drag along right is the right of the majority holders in the company to force the minority holders to sell on the same terms that the majority holders are selling. So if the majority holders get an offer to buy the company for $20 million, they can force the minority owners to go with. So it avoids the possibility where a minority owner can object, can dig their heels in, or can even stop a sale. And if you don't have that agreement, they may be able to do that. I think that's what everybody's trying to avoid here.
Yeah, we had one where a 0.5% owner delayed us a couple of days just out of principle to make themselves part of the process, for better or worse. But yeah, no, very, very helpful commentary. Thank you.
Was it principle or money?
The money didn't change. I think he just wanted to be he just wanted to be heard, I guess.
Okay.
Do you know, Blake, whether or not that particular company had a shareholders agreement with the drag along?
They did not. No. So
Yeah,
they
because
were
in my
yeah.
experience, I don't see that provision very often included. It's a great provision to have, but I'm surprised how often it's not included. Same thing with internal transitions where you've got the put and call or the Texas shootout where one partner wants to buy the other, and without that provision that says that one or the other has the right, it can prove very litigious, I think.
Yeah, any 50-50 ownership situation is kind of fraught with issues, and we do our best to address those, but it can be really difficult. I think that the drag along right just makes it a lot easier to do an equity sale of the company. An asset sale is usually an option, but I know if I am in control of a company, I want to have the flexibility. And if I'm the buyer, I certainly want the flexibility to buy assets versus equity. And if we don't have a drag along right, that maybe takes the equity sale off the table and requires us to do an asset sale or some other kind of legal gyrations to get the company in a situation where we don't need that minority consent.
Yeah, that's interesting, and unfortunately, we've all probably seen the hazards of that. But again, that's something we did a webinar a few months ago about the buy-sell agreement. But again, that's just a document that, at a minimum, you should be reviewing it with your partners every 3 years at least. Making sure that everything still makes a sense in regards of valuation, the terms of the agreement, and so forth. And there was a court case, I think last June, that could potentially impact it. Well, don't digest over there, but again, just taking a moment to look at that. Pat, can you just touch on briefly about documentation around employees and then even contractors? Again, that's an area that can become a little hairy during the whole sale process.
You read my mind. I was going to go there even if you didn't ask me the question. So that it's very perfect timing. Employees are important. Many buyers will want to keep the operation in place and continue to use the employee pool that was in place before the transaction happened. Most buyers won't commit to hiring everybody, but frankly, most of them usually do, and then make some changes later on down the road if they want to. But the things that are really important for employees, especially for companies that are involved in the creation of IP, intellectual property, and that can be companies as mundane. If you're a manufacturing company, you're probably creating some type of intellectual property. But we always like to have some kind of agreement. And when I say we, I mean attorneys who sell companies. We like to have some kind of agreement that requires that the employees that work for the company have assigned all of that intellectual property to the company. And that'll be really important to the buyer, especially if those employees are inventing patentable objects. Now, if you're 3M, they've got a very robust and comprehensive scheme to make sure that all of their employees, especially those who are engineering things, have assigned everything. But it's not difficult to have your lawyer put together an employment agreement that addresses ownership of intellectual property and makes sure, confirms that that's all assigned to the company. But there is language that comes right out of section 181.78 of Minnesota statutes that needs to be included in that agreement. And we've had conversations here in our office about the consequence of not having that language. But worst case scenario, if you don't have the right language in there, and this is one of the very few places where magic language actually helps. But if you don't have that language, it's possible that that assignment may be ineffective. So I recommend people talk to their attorneys about it. Other things that are important are confidentiality. There's a general confidentiality requirement under the law, but it's always a good idea to have that with regard to your employees. Another thing that is important and topical are restrictive covenants. Now, we all know that non-competes are increasingly undesirable under the law, and the Minnesota legislature passed the law a couple of years ago that make it very difficult for employers to enforce non-competes against their employees. But there are other less restrictive covenants that your attorneys can help you put in those employment agreements, such as non-solicitation of customers or suppliers, or non-solicitation of employees, so that if they leave the company, they can't come and raid your own employees. They've got to keep their hands off for a while. There's a lot of nuance to this. It's a rapidly changing area. I always defer to my employment colleagues on that, but I think it's important. And it's also something that a buyer is going to look at, because they don't want to acquire a company with an employee pool that doesn't have those reasonable restrictions. Another thing to consider is, what type of compensation those employees might be entitled to upon a sale of the company. Sometimes we don't see stock option plans as much as we used to, but maybe some kind of deferred comp plans or a change of control payments or something like that. And I think you need to evaluate what the effect of a sale is on those people. And lastly, and I see this more or less frequently than I do other things, but maybe something that requires employees to stay put, especially if their position might be eliminated, but they're key to the process. You should consider some kind of what we call a stay put payment, so that they get some kind of bonus as long as they stick around until some point in the future when they can leave, or that they're going to leave, but you provide them a bonus to keep them in place. Otherwise, once the announcement's made that the company's being sold, if they don't have any financial incentives to stick around, you might find people jumping ship.
I don't know if Diane or Blake, if you guys have anything else. Otherwise, I'm gonna move on to go.
I would just add that, it's not unusual in my experience at all for owners to motivate that, again, the key personnel, not all personnel, but the key personnel, with some sort of stay bonus. It's typically, paid like quarterly or semi-annual or even annually, provided that those individuals stay following the transaction. Again, at this panel I was at last week, the question was, that stay bonus, is it a percentage of the proceeds? Is it a percentage of the key people's salary? What's been your experience there, Pat? Has it been sale price or something else?
Unless it's a really key employee, like one of the top 5 officers, I don't usually see it as tied into the sales price, but I do see it as being either a percentage of annual comp or some kind of bonus that's reasonable. I mean, $1,000 is better than nothing, but it's probably not going to motivate people to keep a job or not. 5, 10, 15, 20, that probably changes the calculus a little bit, but you have to keep in mind how much they're being paid. If you're being paid $250,000 a year, $5,000 bonus is probably not going to change your mind. If you're paying $20,000 a year, it's going to definitely make a difference.
Yeah. And with plans like the deferred compensation or phantom stock, which oftentimes I encourage owners to implement, regardless of what their transition is, once one of those caveats in those agreements is that upon a transfer of ownership, those plans pretty much terminate. But boy, very useful in helping align those key people with the owner in helping to grow the company and get it ready for a transition. No doubt.
No, absolutely. And that's the reason for doing those plans, right? Is to align everybody and making sure that they're committed to to increasing the value of the company and seeing it through to an ultimate exit.
Absolutely.
Yeah, before we jump on to the next subject, and I'll just mention, I know I had a client, entrepreneurial client, very took his positions versus employee versus subcontractor, which most of the his talent was subcontractors. But when he went to market, that was hair and a dog that did not sit well with potential buyers, their assessment of whether they were subcontractors or employees.
Did they misclassify their subcontractors? Let me
Very,
just
very overzealous positioning on
let me
considering
just make one short point
subcontractors.
on that.
Yep.
There's a misperception out there that if you're a company, if you're an employer, that you get to decide whether somebody's an employee or a contractor, and that's just not true. If it walks like a duck and quacks like a duck, it's a duck. And if you are subject to all the tests that they use to determine whether somebody's an employee, you are an employee, regardless of whether you're classified as one or not. And not only can you run into classification issues upon a sale of the company, you can also be effectively audited by the state to determine whether people are or not employees. And then you might find yourself on the hook for minimum wage obligations, pension or 401k contributions, benefits, all that kind of stuff. This is absolutely worth talking to an employment lawyer about to make sure you get it right.
Yeah. Yeah. Again, just really have a clear understanding, employee, subcontractor, proper documentation around both of them.
Yeah.
Which then kind of leads us to the documentation risk and the risk reduction, trying to move, whether it's a handshake or verbal understanding, to written agreements on uncovering potential red flags early. Blake, if you can kind of kick us off on that subject.
Yeah, and I think this is, the natural step towards session 3, which is, the profiting session of this series. But, where sealed bid sees this process done well is using a couple of different forms of written proposals to define an offer. And, generally speaking, our recommendation is always that you want to run an M&A process to get multiple parties to the table and to create competition to drive value. But there's no question that deals are done and agreements are at least outlined verbally or by handshake. And our initial thrust when negotiating specifics to a transaction is to use what's called an indication of interest or a term sheet. And this can be, a one-page sheet. It doesn't have to be super complex, but it starts the process of outlining the terms of the transaction, including, potentially a range of value, a description of proposed structure, generally the thesis that the acquirer is using to pursue the transaction, even, potentially how they're calculating their value in broad basis. And what that does, from our perspective and typically representing sellers, is it puts things in a lens where you can truly sit with your transaction team and evaluate the potential of this deal moving forward, and not, start spending legal dollars or other advisor dollars, or, just the passage of time and attention with somebody who isn't aligned with you and your expectations. From there, we like to add additional detail into a formal letter of intent. And, I'll be interested to hear Pat's commentary, but, we've seen letters of intent in our processes get more and more detailed over the last several years. And what that does is exactly your point, Corey, which is reduce red flags, uncover potential issues early, and not let the negotiation process, specifically of the business points, drag out a closing. So our letters of intent will push for defined purchase price and structure, including what's called a sources and uses table, where the acquirer is presenting how much equity and debt they'll be using to fund the transaction. And really what that gives sellers is an understanding of how much leverage and how much comfort the buyer is going to have going forward with any necessary payments or structure issues in how they're coming up with the purchase price. Additionally, as was referenced in our financial preparedness, working capital calculations, really understanding how the buyer is looking at that working capital component of a deal. And their due diligence process, timeline to close, and we'll go as far even to request indemnity expectations and outlines of sellers' representations and warranties. So it's the more you can get into that formalized letter, which often requires exclusivity once it's executed, the better. And Pat, I would be curious to hear your comments on what you're seeing in those formalized documents.
I think you're absolutely right, and I agree with everything you said. I see as far as the complexity and detail that LOIs have, I do see a range, and a lot of it has to do with the size of the deal. Obviously, the bigger the deal, the more complex it's going to be. But usually any transaction that has professional advisors, financial advisors, legal advisors is going to include a lot of the things that you talked about that may not necessarily occur to the business owner, such as what is the limitation of liability on the deal that the seller is at risk for if something happens on the back end? What is the duration during which the buyer can bring those claims? Are we getting, for example, rep and warranty insurance, which is a third-party product which can protect the seller against these claims from the buyer? It is important because even though they seem like legal points, they really do affect the deal in the long term, and they're going to have to be dealt with. I do want to make one observation at its on a base level, which is a letter of intent is not a different kind of agreement. And you mentioned when you were talking about these, Blake, that they should be non-binding. But it's really important that people understand that if I sign a letter of intent that says, hey, I'm going to buy this business from seller A, and I'm going to pay X dollars for it, and then we're going to put it in agreement later on, unless it includes language that says it's non-binding, that letter of intent can be binding and enforceable. So I'm going to put in a plug, and it's maybe self-interested, but I think it makes sense to get those professionals involved at that stage. I know that if I get brought into a transaction at the point after a letter of intent has been signed, I missed an opportunity to help frame that discussion and make sure that everything's taken care of. If you're dealing with somebody like Sealed Bid, you're in good hands, obviously, because they've done a lot of deals. But I do think it makes sense to get your lawyer involved earlier rather than later and make sure you're protected.
Totally concur. Yes, we definitely like to have that, and it's our first subject matter in session 3, which is assembling your deal team. There's a lot of business point negotiation that can happen prior to the reviewing letters of intent, but at that stage, you're far enough down the process to definitely involve legal, consider the tax implications with your CPA, and involve all of the other key members of that deal team.
I think that the point of that before you actually get the letter of intent signed is to know clearly what you want as the seller out of the deal, and that have it be expressed. The buyer will obviously have some say in that, but for example, I wouldn't go into a letter of intent discussion without knowing what purchase price I wanted. And you mentioned that, but I've seen LOIs that say, we'll agree what the price is later on. And that's a recipe for disaster.
Yeah, I think that's a good transition. So once you have agreed to a more formalized offer and you're beyond that handshake process, one of the main things that we see that drives certainty to close, keeps people marching in the same vein is a defined due diligence process, and making sure that you're working quickly through the request lists and driving urgency to get the sign-offs on financial diligence, get lender approvals if they're necessary, start, as you had previously mentioned, Pat, understanding what type of consents and assignments are required, and even to the point where you're starting to do real estate pieces of transactions where there's an environmental study or other requirements. Those things in a silo can be simple, but all together and moving on a timeline need to be managed to make sure things progress rapidly and successfully.
Absolutely. It becomes a full-time job on the part of the seller, much less their advisors.
Yeah, and I can't emphasize enough. I've seen it where the LOI is just executed by both parties in a haste manner versus really getting clarity. within the LOI, and then when the negotiations really begin post the LOI in drafting the purchase agreement or equity purchase agreement, asset purchase agreement, then you can really drum up legal cost on that once you're trying to negotiate during the drafting of an agreement versus having a clear understanding, whether it's working capital, indemnification. And I had one client I saw indemnification was pushed off till about 4 days before closing, really by the buyer, and they wanted full indemnification from the sellers, which just was not market.
Nope.
Not market at all. However, they dug in the hills and pushed it out about 3 weeks longer, and eventually the buyer did come around, but it was, if they would have just our client was willing, like, you know what, if that's really what you want, we're pulling the pin, but then you've exhausted that was about a 120-day process, and then you've got to go back into the marketplace again. So
I think anytime either party is unwilling to articulate their position on a fundamental deal point, it's a red flag to me, and it tells me that they're holding on to that for some other reason. In your example, I'm guessing that the buyer never intended to offer market indemnification, and they were able to drag their heels out and try to hold the seller's feet to the fire.
yeah, exactly. But again, I think this will kind of go into the third part profiting from this, but making sure you're pulling your whole team together early on that process, even the letter of intent or indication of interest, having your CPA, your attorney, your business advisor participate in that, and let them bring their vast experience in doing this, because I would say most of my clients have not done it before. And so it's kind of uncharted territory. And especially when you get into an agreement with like a PE, that's all those guys do. And they've got her fine tuned, and they know how to make it smooth or feel smooth.
Feel smooth.
It's their business. That's their profession.
That's right.
Yeah.
And they're good at it, but they're smooth at it too, right?
Yeah.
Yep, definitely. Well, we've covered a lot of ground, and I don't see any additional questions from our participants that are listening to this. Hopefully everyone, hopefully you get a golden nugget from this conversation. Again, Diane, Blake, and Pat, I appreciate your time and your knowledge in this area. If anybody ever has any additional questions, please follow up with them. We will be sending out a recording to those that were able to attend, and then those that registered but were not able to attend. And again, if you do have any follow-up questions, whether it's legal or on the deal side or helping on the inside, just reach out to one of us, and we'd love to help you. Thank you, and have a good rest of the day, everyone.
Thanks.